Let's talk about something that is so frustrating. You've done all the work. You've built your plan. You've spotted the perfect setup. You know exactly what you're supposed to do. But then the moment comes to actually pull the trigger and nothing. You freeze. Or even worse, you just throw the plan out the window. It's one of the toughest experiences in trading, and believe me, it is way more common than you think.
This quote right here from TradesViz, it probably hits a little too close to home for a lot of us, right? That hesitation, that constant search for just one more reason to feel certain, it costs you. And for those of you who might not know, 2R just means the price moved twice the amount you were willing to risk. It's a huge missed opportunity. The bottom line is, while you're busy overthinking, the market is busy moving.
So what is going on here? Why do these perfectly good, totally rational plans just seem to, vaporize the second real money is on the line? Well, that's the big question we're going to tackle right now. We're going to unpack the psychology behind why we fail to act, and then, more importantly, lay out the systematic approach that the pros use to get past it.
Okay, so first things first, let's put a name to the enemy. We're going to call it the analysis paralysis trap. This is where we're going to look at two very specific self-sabotaging behaviors that can wreck even the best strategies.
First on the list is analysis paralysis itself. It's funny, we always talk about impulsive trading, but this is the exact opposite, and it can be just as expensive. It's that endless hunt for certainty in a world that's all about probabilities. And you know where it leads? To the sidelines, watching your idea play out perfectly, but without you.
And then you've got its emotional twin, revenge trading. You take a loss, and suddenly the goal isn't about executing your strategy anymore. It's just about getting your money back, about erasing that feeling of being wrong. This isn't strategy, it's just raw emotion, and it's how normal, totally acceptable losses snowball into account-destroying damage.
But why do we do this? Why are these reactions so common? Well, to find the fix, you have to get to the root of the problem. So let's take a look at what's actually happening inside your brain when it's looking at the markets.
Okay, here's a truth that's going to sound completely backward, but it's so important. All that time you spend glued to your screen, watching every little tick, thinking you're grinding or putting in the work, it's actually making you a worse trader. It's not dedication, it's self-sabotage.
Now, this slide breaks down exactly how that damage happens. There are 4 real costs here. First, decision fatigue. Your willpower is like a muscle. It gets tired. Every little up and down tick you react to drains it. Second, emotional erosion. That constant noise turns you into, and I love this phrase, a chemical pinball machine, just bouncing from fear to greed. Third is the illusion of control. This kind of magical thinking that staring at your position is somehow going to influence the outcome. And finally, and maybe most importantly, plan erosion. Your calm, rational plan gets slowly melted in what one trading psychologist calls the acid bath of live market emotion.
And if you dig even deeper, underneath all of this, you find these powerful psychological triggers. It's not really about the charts you see. It's about our deep-seated fear of being wrong. It's about our ego. It's about that perfectionism that tells us every setup has to be flawless, which, of course, they never, ever are.
Okay, so that's the problem in a nutshell. It's a lot, I know. But here's the good news. What's the antidote? How do professionals basically immunize themselves against their own brains?
This slide, I think, shows the whole game right here. It's a fundamental shift in mindset. The amateur is obsessed with the outcome of one single trade. I have to make money on this trade. The professional, they're obsessed with the process. Their goal is, I need to execute my plan perfectly. They see losses not as some personal failure, but just as a statistical cost of doing business. Like a restaurant owner accounts for broken plates. It's just part of the game.
And that brings us to the absolute heart of the solution. A systematic, predefined plan is the only reliable antidote to making decisions based on your feelings. You're not building a system to manage the market. You can't. You're building a system to manage yourself. You are replacing gut feelings with a process.
So let's look at a really powerful, data-backed example of this concept, but from the world of long-term investing. It is a perfect illustration of a simple system in action. We're talking about portfolio rebalancing.
Just take a look at this chart from Vanguard. It's fascinating. If you don't have a systematic plan, a simple 60% stock, 40% bond portfolio will naturally drift. Over a few years, as stocks tend to do better, it can slowly turn into a much riskier 80-20 portfolio. And this happens without you doing anything. Your risk profile completely changes, and you might not even realize it. But now, Look at the solution. Vanguard's research found that a simple, systematic rule, just rebalancing the portfolio back to its target once a year, hits the perfect sweet spot. It fixes that risk problem without making you trade all the time, which costs money and creates noise.
And they actually put a number on this benefit. They found that sticking to that simple annual plan adds 51 basis points. That's just over 0.5% of value compared to someone who's overactively rebalancing every single day. That's the real measurable value of having a calm, disciplined process.
Okay, so how do we take this idea and apply it to our own decisions? How can you actually build a system that protects you from your own worst instincts? Let's talk about building your personal execution edge.
Here are 3 really concrete, actionable things you can do. First, create a binary checklist. This means 3 to 5 objective rules. If they are all checked yes, you take the trade. No debate, no feelings. Second, set time limits. Give yourself, say, 2 minutes to analyze a setup. When the timer dings, it's a yes or a no. That's it. And third, and this one is absolutely critical, separate analysis from execution. All your research, all your thinking happens when the market is closed. When the market is open, you are not an analyst anymore. You are an operator. Your only job is to execute the plan you already made.
So this is all about replacing that compulsive screen staring with strategic screen time. Define your operating hours, have a pre-market ritual where you plan your day with a clear head, use price alerts to free yourself from the screen, let technology watch the market for you, and always, always conduct a post-session review to see how well you followed your process.
And what about when you do have losses? Because they will happen. Well, pros have strict, non-negotiable rules for this too. They have daily loss limits. They take mandatory cooldown periods after a big loss to clear their heads. They risk a tiny, fixed amount on every single trade, often less than 1%. And maybe the most important rule of all, they judge a trade based on how well they executed their plan, not on whether it made or lost money. So this all brings us to one final, really crucial question I want you to ask yourself. After everything we've looked at today, is your trading or investing plan, is it really designed to manage the unpredictable chaos of the market? Or is it, and maybe, should it be, designed to manage the very predictable chaos of you?